Welcome to Excess Returns, where we focus on what works over the long term in the markets. Join us as we talk about the strategies and tactics that can help you become a better long-term investor.
Justin Carbonell and Jack Forehand are principals at Validity Capital Management. The opinions expressed in this podcast do not necessarily reflect the opinions of Validity Capital. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Validity Capital.
Hey guys, this is Justin. In this episode of Excess Returns, Jack and I discuss the trend towards passive investing over the last 10 years, and we ask the question, are these flows distorting the market and some stocks more than others? For example, are the largest stocks in the market disproportionately benefiting from the inflows from passive? Or are value stocks underperforming as their weights get smaller or as certain names are excluded from the major indices? This is a question on the mind of many smart investors, and we take a stab at talking about these trends and the implications for investors to be thinking about. Thanks for listening. We hope you enjoy this discussion on the rise of passive investing. All right, today we're going to tackle the question of is passive investing distorting and influencing the markets in some way that might not be good, or at least in the sense, is it driving up valuations of certain companies, maybe more than they should be, or is it maybe driving down the valuations of companies that maybe aren't in some of these passive related indexes? But to just set the stage, I think, before we sort of discuss this, is you wrote an article a few weeks ago kind of asking this question, and you had really two important charts in there that just kind of show how big passive investing has actually gotten relative to active investing. And the first one showed basically the passive equity flows going back to 2009 versus active equity. And what you see is and we'll put the charts in here, but you see it like a massive decline in active equity flows. And then you see this massive cumulative flow increase in passive investing strategy. So that's one thing. The other chart that you had in there is you had basically the percentage of AUM or assets under management in active strategies and the percentage in passive. And basically they're close to 50%. I mean, it used to be a lot lower than this, but over the last 10 years, for a lot of different reasons, which I think we're going to discuss in a minute, passive investing has largely caught up to active investing. So maybe Jack, to hand it over to you, what are some of the things that are driving this increase in money flowing into passive?
Yeah, like you said, I mean, passive is probably something like 45% of the market now. And that's obviously a huge, increase from what it was, just a decade ago. And there's obviously good reason for that. Number one, active managers have done a pretty terrible job of trying to beat their benchmarks. And number two, passive vehicles are much less expensive. So those two things coming together obviously lead to a significant inflow into passive. And that's obviously a good thing. And the question here is, are there other effects that then become side effects of that as that money flows in, which maybe are less of a good thing? But we'll get into that in a second. But the first thing I think we want to do is set the stage for what's been causing this to happen. So there's been a few different things going on. One is obviously there's been a big increase in regular contributions to things like 401ks. And the way 401, and we won't get into it here, but the way 401ks are set up from a regulatory standpoint, there's an enormous incentive to have passive be the default option, to have passive options for people to put their money into. And so the vast majority of that 401k money that's flowing in, particularly from younger investors, is flowing into passive vehicles. And the other thing that's happening is what we just talked about, which is active managers are being fired and replaced by passive. And most of them should be, because they haven't produced returns above and beyond their fees. So that also is causing a rotation from active to passive. And then the other thing to keep in mind is younger investors in general use passive vehicles for the vast majority of their investments, whereas older investors use active vehicles more. And so what's happening is you get this rotation because younger investors are investing into the market. They're in the phase where they're putting money in right now, whereas older investors are in the phase where they're withdrawing. And so those two trends also lead to an increase in passive within the market.
Right. And so those trends can have, I think, two important impacts on the market. One, they can drive up the overall valuation of the market. So that's one thing, and we'll talk about that. And then the other is it can impact the relative pricing within the market. So do you want to kind of discuss
So
those
first,
two things?
we'll mostly deal with the second one, but the first one is this does have what happens when money flows into passive vehicles is it flows into the largest stocks, and as it continues to flow, those stocks go up more, and it flows more and more into those largest stocks, and those largest stocks become a much bigger weight within the index. And I think we're seeing right now the largest stocks represent, historically, this is one of the larger times in terms of the percentage they represent of the overall market. And so that can just build upon itself and drive up the overall market, because as you drive up those large stocks, you also drive up the overall market. But the other thing, which I think was really interesting, and this comes from Mike Green's work, who a lot of this data regarding the increase in passive and its impacts comes from, is most active managers hold a reasonable cash position. So most active managers say hold 5% in cash, whereas passive vehicles have almost zero cash. When we ran an ETF, we had almost no cash in there. So what happens is when money flows from these active managers to passive managers, you end up with a significant amount of money being deployed into the market that wasn't otherwise deployed into the market. And that has the ability to actually drive up the market a lot, if you think about it. I mean, if you think about 5% of the money invested across all active funds, in an extreme scenario, which obviously is not going to happen, where everything goes to passive, that entire 5% or most of it gets invested into the market. And that has the ability to produce a significant upward pressure on the market. So there's the arguments that basically summarizes the arguments that passive is impacting the overall market. It's driving up the overall market. And the only other point I would make there is the effects of all of this are not really linear. And what I mean by that is, as active gets smaller and passive gets bigger, if you believe these effects are happening, the effects will get bigger and bigger and bigger. And so the next 10% could have a much bigger impact than the previous 10% did. So all of that is, that's not to say any of this is actually happening. It's more, those are the arguments in favor that this could be driving up the market overall.
Right. And then the second point, I guess the second impact was, the relative pricing within the market itself.
Right, and that plays on the same thing we were talking about, which is as more and more money flows into these stocks that are going up more and more, you end up driving up the prices of those stocks relative to other stocks, relative to the stocks that have smaller weighting in the index, but also relative to the stocks that just aren't even in the index at all. You can argue that this will cause a continuation of a trend where the largest stocks keep getting bigger. Now, the flip side of that argument is, these stocks that have become the biggest percentage of the market, the Googles and the Amazons and the Apples of the world, those are businesses that are doing really, really well. And so you can argue that those businesses deserve to be going up as much as they are, and they deserve to be, as large a percentage of the market as they are. And so there's no way to disentangle this. There's no way to say, here's how much of this is due to passive investing, and here's how much of this is due to the businesses themselves. In reality, almost all of it could be due to the business themselves, and this passive investing thing could be a minor impact. There's really no great way to figure that out. But that's an argument against that this might be an impact of passive. But you are seeing in general, if passive was impacting the market, you are seeing the types of things you would see, which is these larger companies getting bigger and bigger.
One of the things that, comes up a lot is a lot of people tend to try to use the current environment we're in and compare it to like what happened in 2000 or 99, 2000, which is you had, all these technology, mostly companies, had these nosebleeds, crazy valuations. And then obviously when the air came out of that, the NASDAQ fell, I don't know how much it was, but by more than 50%. And many of those companies, went out of business altogether. Now that to some extent actually sowed the seeds for some companies that survived, like Amazon, the Amazons and Apples of the world that, are now some of the most successful, like you said, very, very, very successful companies. But that is an important thing, I think, to remember, is that a lot of these technology companies that are the largest companies in the market today, they are really great businesses, high quality businesses, very solid balance sheets, cash flow generating machines. But, they are trading at valuations that, for the most part, people would think, if you're a fundamental investor, at least, that would be considered expensive. And these companies need to continue to deliver on, generating good business and profitability, if those valuations are going to keep and sustain at those levels. But that might relate to sort of the point of, and this is a quote, that pretty much anybody that's read anything about Benjamin Graham or even Warren Buffett knows that, in the short run, the market is a voting machine, but in the long run, it's a weighing machine, which means that fundamentals matter the most over time. But in the short run, obviously psychology and enthusiasm and things like that can drive stocks much more than fundamentals. But the point is that voting machine maybe can happen for longer than people think. And so, those are just sort of some things to sort of take into consideration when people are thinking about the current market environment versus what happened in 2000 to 2002. And then also that, these trends can last longer than many might.
Yeah, and flows are an example of the market being a voting machine, because if you think about it, I mean, what determines whether a stock goes up or down is who wants to buy it, what are the flows going into it, and what are the flows going out of it. And so in the short term, something like passive investing could, the flows that are generated by that, people are voting with their dollars and they can drive up certain stocks relative to certain other stocks. But, you would think in the end, eventually, you'll have a situation where fundamentals will matter. And we'll talk about that a little later in the podcast, but we don't know how long that's going to take. That could take a very long time. And like you alluded to, the market could be a voting machine for a very long time here before it eventually becomes a weighing machine.
You at one point tried to derive a formula where you looked at like the liquidity of the stocks based on their volume, and then tried to back into those companies that might be influenced the most by these passive flows. I don't think in the end, I don't think you sort of thought what you had done was like the most accurate, but it was a good thought experiment. So what did you exactly do there with that?
Yeah, we've sort of left out the other part of the equation in what we've talked about so far, because the market cap weighting of the stocks and passive indexes, that's what's determining how much money is going into them. But then there's the other part of it, which is how much can they actually handle? And that's where liquidity comes in. Because if all these stocks could handle the money coming in relative to their market cap, then you probably wouldn't see a huge impact here. But if you're going to argue passive investing is having an impact, then you would expect the stocks that have the most flows in relation to their market cap coming in relative to their liquidity, those would be the ones that would do best. Now the hard part about that is measuring liquidity is really hard. And, I wrote that article a few years ago, and I tried to measure liquidity by daily dollar volume and to say, the stocks that had the most money coming in relative to the daily dollar volume, those should be the ones that are going up the most. And my research found that didn't work at all. And the reason is, I think, I wasn't representing liquidity properly. I don't think daily dollar volume is probably a great measure of liquidity. And to give you an example, when I applied my formula and I said, all right, what stock should passive investing be impacting the most? The answer was Berkshire Hathaway, because Berkshire Hathaway has the largest market cap relative to its volume. But Berkshire's volume doesn't really tell you anything about how much money it could accept in terms of trading. It just tells you how much actually traded on any given day. And I think that's the problem. I mean, no one would argue that the biggest beneficiary of this passive wave has been Berkshire Hathaway. So my model was wrong, but I think there's people with more advanced models that look into like things like the order book that may be trying to do this and trying to figure out, well, the S&P 500 benefits from this, but if I can identify the specific securities that benefit the most, I can have even better performance than the S&P 500. And so I think there's people out there trying to do that, but I think it's a difficult thing to do.
Well, the other thing that we talked about, I thought, was if you're making the argument that the companies at the very top of the S&P are benefiting from flows, then so should those companies that are sort of, or maybe, I don't know about this, but the money gets distributed in the index according to the weight of each constituent. So, some stocks in the S&P are going down, some stocks are going up. Obviously, the biggest ones are going up the most, or at least they have been more recently. So, but that might just be a function too of those are, included in a lot of other sort of portfolios, and maybe not just these passively weighted indices. See, this is why it's tough, because you can kind of, when you think about it and try to get deeper into it, you can sort of start to see the arguments for maybe why it's not the case. But anyways, sort of moving on to this other point, which I think we talked about it with, who did we talk about sharps risk? Was it with Toby, or I forget?
Corey Hoskins.
Corey Hoskins, yeah. So why don't you just real quickly give an overview of what the arithmetic is for sort of active and passive equaling in the market?
Yeah, well, what Sharpe's arithmetic says is that if the overall market obviously is the overall market, then if part of the market is active and part of the market is passive, and passive has to represent the overall market, then active also has to represent the overall market. And so what that means is, in aggregate, there's really no difference between the holdings summed up of active and passive. Obviously, within there's managers within active that have very different weights, but overall, it has to sum up. And so some people will say that as an argument as to why passive investing shouldn't be impacting anything, because if money's flowing into active is the same thing as passive. But when you look behind the scenes, and that was the example Corey gave us, you can sort of understand why it could have an impact. And what it comes down to is, although the holdings between them may be the same, relative pricing can be changed by flows within there. And so Corey gave us the example of, if you have three investors, one's a passive investor, one's a value investor, one's a growth investor. What happens if the value investor capitulates and decides, all right, I've had enough of this underperformance, I want to now use more of a growth-like portfolio? Well, in order to do that, the value investor has to buy growth stocks and sell value stocks. The only other person in the market, the passive person, is doing nothing by their design. So the only other person in the market that's going to possibly have those transactions with them is the growth investor. And so if they want to buy the growth portfolio, the growth investor is going to ask for more and more money. And if they want to sell the value portfolio, they're going to have to sell it at lower and lower prices to the growth investor. And so although Sharpe's arithmetic continues to hold in that example, what's happened is the relative pricing has changed, and the growth type stocks have gone up and the value type stocks have gone down. And so if you aggregate that across a lot of participants in the market, you can sort of see an example of how this might be impacting what's going on in the market.
Yeah, good point. I think one of the sort of moving towards maybe the arguments against this, or what would happen if if this is true and flows continue to go to passive, and it continues to drive the companies most heavily weighted in these passive indices up higher, and you get a divergence from what the fair values are of these companies, both overvalued and undervalued, you would expect active investors to hopefully be able to step in and correct that, because if there is these real bargain companies out there, stocks out there, based on the underlying businesses, you would hope that the active managers would be able to, over time, identify those and step in and basically correct that from happening. I mean, so that's one thing that a lot of people say, is that eventually, if there's such a divergence between the fair value, the fundamental value of these companies and their valuations, that you would have active managers step in and right size that.
Yeah, so there's two ways you can look at that. One is you can look at that is that's what active managers are doing right now. And so the reason, like we talked about before, the reason these companies have gone up so much is because their fundamentals are really good. And so if this really was a divergence from their actual value, you would see active managers stepping in to correct that. And so that would be the argument, that there still are enough active managers, and that's what's actually happening. Now, the flip side would be, as active has gotten smaller, you could argue, well, there aren't enough active managers to do this anymore. And so what happens is something like these passive flows can impact the market without active managers stepping in to correct the mispricing. And I don't know the answer to that, but that is one thing you would expect. In an efficient market with enough active management, you would expect if these prices get too far from what they should be, the active managers will step in and they'll correct them. Right. It's important to understand that these are businesses. And so businesses are valued based on their cash flows, and businesses have things they can do if their value gets too far from what it should be. Other businesses can step in and they can buy them. Like you said, they can buy back their stock. they can pay a large dividend. I mean, some of these growth companies that have very high multiples could find value companies that have very low multiples that they have synergies with, and they could acquire those companies knowing that those earnings will have a higher multiple applied to them once they're underneath the growth company. So there's a lot of things that could happen if this gets too far, just on a company specific basis, where the companies or acquirers could step in and correct it.
It's funny, when we had John Rakenthaler on from Morningstar, we sort of asked him, in terms of when you look out on the horizon, do you see anything that might change, this shift towards passive? And he couldn't really see anything. And this is a guy with almost 30 years experience in the market who's seen the changes in the asset management business and the rise of passive. So it's hard to see sort of what knocks this down. I mean, a long bear market would, of course, probably mean a lot of money would come out of passive, but it would also mean a lot of money would come out of active. And, since the great financial crisis, actually, you've seen, like your chart shows, you've seen much more of a move towards passive. And so his point, I think, was, active really needs to, for active to get back and sort of for the flows to start coming back into active, you need to see, like in a bear market, let's say, active really shining or protecting investors for that sort of, change to happen. So he couldn't, he couldn't see what would drive it other than a real good boost from active management. And then to sort of the other guy we had on was Lawrence Cunningham. And, I think you asked him if he was concerned about the rise of passive, and he gave his reasons why he was concerned. So, I mean, these are smart guys that know a lot about the market and history. And, and I think this discussion is an interesting one. And it's going to be one that I think investors are going to be having for probably a long time, because this is clearly a trend in the business. And, who knows how it's going to end, good or bad. Ultimately, passive investing, it's really good because the fees are low, and it takes sort of this stock picking out of, trying to pick a manager, trying to find the best strategy. I mean, passive investing is probably great for most investors. It's just, there are these questions that are emerging from the rise of passive.
Yeah, I think you're right. I mean, I think it's very hard to argue that this trend is going to stop. But what you can argue is whether this is having an impact or not. And that's what we've tried to give a balanced take on that. I mean, to be honest, I have no idea. I mean, I've looked at the arguments on both sides of this, and I really have a hard time saying whether there's been an impact and whether that impact has been significant. Yeah, I think there's really good arguments on both sides of it. So what we're trying to do here is just sort of outline the arguments, not to say we're in favor of them or we don't believe them. I think I think some of the smartest people in investing are wrestling with that right now. And I don't know that there's a great answer.
Yeah. All right. Well, hopefully you guys found this discussion on the rise of passive and the implications an interesting one. Thank you for listening. We'll see you next time.
Thank you.
Hi, guys. This is Justin again. Thanks so much for tuning into this episode of Excess Returns. You can follow Jack on Twitter at @PracticalQuant and follow me on Twitter at @JJCarbono. If you found this discussion interesting and valuable, please subscribe in either iTunes or on YouTube, or leave a review or a comment. We appreciate it.